and gentlemen, good day and welcome to Expleo Solutions Limited Q2 FY2024 earnings conference call.
Well, yeah.
As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. And now hand the conference over to Ms. Asha Gupta from E&Y Investor Relations. Thank you, and over to you, ma'am.
Thank you, Seema. Good afternoon to all participants in the call. Welcome to the Q2 FY24 earnings call of Expleo Solutions Limited. The results and press release and presentation has been already mailed to you, and you can also see the same on the company's website. In case anyone does not have the copy of press release and presentation, please do write to us, and we will be happy to share with you all. Representing the management today, we have Mr. Balaji Vishwanathan, Managing Director and CEO, Mr. Desikan Narayanan, Chief Financial Officer, and Mr. Paryakaruppan Palaniappan, newly appointed CFO. Balaji will start the call with a brief overview of the quarter gone by, which will be then followed by Desikan, who will be getting into detailed financials. After that, we will open the floor for Q&A session. As usual, I would like to remind you that anything that is mentioned in this call, which gives any outlook for the future or which can be construed as forward-looking statement, must be viewed in conjunction with the risks and uncertainties that we face. These risks and uncertainties are included but not limited to what we have mentioned in the prospectus filed with the SEBI and subsequent annual reports, which you can find it on our website. Having said that, I will now hand over the call to Mr. Balaji. Over to you, Balaji.
Thanks, Asha. Good afternoon to everybody who has joined the call. Thanks once again for taking the time. For Q2, that is July to September quarter financial results, were closed yesterday during the board meeting. We have had some positive momentum during the quarter compared to the previous quarter, where we showed a marginal decline in our revenues. However, we still have pressures on our profit margin. This quarter, primarily the profit margin is around, bench and some of the investments that we have done on people. So the people cost is slightly higher, and the training costs and the upskilling costs are slightly higher. There are also some impact due to some one-time costs that which we had to incur in terms of consultancies and other stuff. But overall, we are the overall business pipeline looks reasonably good, but will be a little soft in the next couple of quarters, in line with what you see in the overall industry as well. We have signed some, good engagements in this quarter, primarily on the digital space around DevOps and, some part of digital transformation projects that we have signed. But the larger deals are still, in the works, and that is one of the challenges that we are trying to address, as the customers start getting more budgets and increase their discretionary spends, which they are approaching with a little bit of caution in this particular time. We had some challenges with the cash collection cycle for the last quarter because of some of the larger payments getting delayed due to some procedural challenges. But subsequently, during the month of October, most of them have been collected, and we are in the range of around 85 to 90 days now, which is our expectation is, closer to the around 80 days range, and we are very close to that, the target in terms of DSOs. I'll now hand it over to Desikan. He's unwell, but we'll try and cover, a bit of what we could talk about in detailed financials, but more we will try and answer during the question and answer session. Over to you, Desikan.
Yeah. Thanks, Balaji. Good afternoon to all. I will walk you through the quarterly performance. We will start with the quarter-on-quarter performance. The performance has been almost flat. The revenue for the quarter ended at 234 crores against 225 crores in the previous quarter, 4% up. EBITDA margin was at 15.1% against the previous quarter of 15.4%. EPS slightly increased to 13.2 against 13.0 in the previous quarter. On the cash balance, as Balaji was mentioning, we ended up with a cash balance of 129 crores against 164 crores in the previous quarter. The DSO was almost flat at 119 days compared to 118 days in the previous quarter. It is important to note that we had a record collection in October. It's gone around 126 crores. If I do apply that in the DSO, it will be in the range of 85 to 90 days. The cash balance in around the end of October is around 177 crores. Now we'll talk about the year-on-year for the same quarter. With a 6.6% increase, we ended up with a revenue of 234 crores. What's note that we had a one-time revenue in the previous year same quarter for an amount of 106 crores. To make it as an apple-to-apple comparison, if I do that, then my revenue increase will be around 12%. And since this revenue did not have any cost related to it, as it was due to change requests accepted by the customer after a long follow-up, the comparable EBITDA margin for the previous year same quarter is 17.4% against 15.1%. So the drop is mainly due to the payroll increase during this year. The net cash balance last year same quarter and the current year was the same 129 crores. With this, I'm opening it for a Q&A session. Please go ahead.
Yeah, I'd like to take this opportunity to thank Desikan. Desikan has decided to move, and he's been with us for close to 8 years and almost 5.5 years as the CFO. I'd like to thank Desikan for all the help and support, and then running the organization as a CFO. And I would also like to welcome Periyakarapan Palaniappan, or what we call him as Money, as the new CFO who will take over from the 1st of December onwards. Money comes with extensive experience in financial planning, analysis, and many other finance functions. He was with Fractal Analytics prior to joining this, but he has worked with multiple other technology services companies in the past. So thanks, Desikan, and welcome, Money. Over to the Q&A session.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Rohit from iThought PMS. Please go ahead.
Yeah, good afternoon, Balaji, and wishing the team a very happy Diwali. So a few questions, Balaji. So one is, in terms of our engineering services business, if you can just give us some numbers, what's been the growth there, or are we seeing any growth? If you can just share some numbers of that division first, and then I'll get to the other questions.
Sure. Hi, Rohit. Thanks for the wishes, and wish you the same. So, in the engineering services business, there are two parts to it. One is what we do here locally within what we call it as the India-Asia markets, and what comes from the group. The growth in the engineering services of the business that is transferred from the group, there has been significant growth. We've seen good traction in the last 6 to 9 months or rather. That is probably the share of the group revenue is increasing primarily because of what is being transferred from the engineering services rather than the technology services, where we have seen a decline even from the group business as well. As far as the direct business is concerned, we certainly see some slowdown in engineering services as well. we're not seeing the same amount of traction as what we used to have, in the previous years. Because most of the work that we do in the engineering services in the direct market is, not so much in the digital space like what we had mentioned earlier, and that particular segment is certainly not growing, and it's almost flat. And in some specific segments around the production engineering, there has been some amount of decline as well.
Sure. So, possible to give any numbers in terms of what are we doing? Because we used to give out numbers from a subsidiary standpoint when we were not listed. So, would you be able to share some numbers as to what the engineering division is doing right now? And also, right now, broadly, what would be the share of digital versus or mechanical kind of engineering services in our portfolio today, a combined direct versus our business from the group?
Yeah, I'll probably try and give it at an approximate range rather than getting into specific, number per se, and I'll probably try and restrict it in the millions, or rather euro millions rather than in rupees. So the engineering revenue, typically what we do in the direct business, that is what we do directly with the customers, end customers, normally has been in the range of around million or so in a month. Million euros per month is what our normal revenue is, which is approximately 8.5 to 9 crores, is what our range used to be earlier in the direct business. And that is now, almost dropped by a little over 10%, and it's in the range of around 850 to 900 K per month, or approximately 7.5 to 8 crores per month. And the group business, we normally try and count it with the number of headcount rather than just the revenue, but the range is that we were close to around 550 to 600 people delivering for the group, in terms of build headcount last year. And this year we are close to around 800 people doing the same amount of business. So close to around 20 to 25% growth in the engineering services business that we do for the group.
Got it. And so I think, so roughly you can say, based on the numbers that you've given, about 40% would be direct business and the remaining would be a group business in engineering services. Would that number broadly be correct?
Yeah, this time it is probably even lesser. It's probably
right.
1/3 is the direct business and 2/3 is the group business in the engineering services.
Right. And sorry, what the other part was around digital versus more mechanical kind of engineering services, or non-digital, if you will, on the engineering services side of the mix.
So the production engineering work that we do, production or mechanical engineering work we do, earlier used to be around 70% of the business and 30% was on embedded and digital services. Right now it will probably be around 60% versus 40%. So that's the side that is growing.
So, maybe 2 years out, let's say this 60%, this 40%, can the mix reverse? From 40%, can it go to 60% from the digital side? And will that is the line of the business that's growing, Rohit, right now. So, and we expect that that's what will grow as well in the future. And our expectation is that it should be 60-40 or 70-30, maybe in a couple of years' time. And will that also have an impact on the margins over that time, 2-3 year period?
So the group's business will not have a very significant impact on the margin, because the group's business, as we all know, work on the cost plus model. So it may not really have too much of an impact. Most of the margin impact will be as we grow the direct business.
Got it. Okay. Understood. So from direct to our business, from a direct to a group business, are you looking at some optimal mix for the company in the engineering side? Obviously, right now it is growing, the group business is growing, but from an overall, let's say 2-3 years view, what's your sense there?
So at this particular point of time, we are not growing very aggressively on the engineering side of the direct markets because we need to build some scale, and that is something which we will get from what work we do with the group. But these geographies, that is the India and the Asia geographies, is where some of the traction is for both automotive and in the transportation segment. So we will have a more aggressive direct market plan maybe a couple of years down the line, but not right now. Right now, our focus is to try and build the capability through what we can do for the group.
Right, got it. And just 2 more questions. One on the hiring side. So obviously this year has been a bit slow, what is our thought process? We had shared our plans to get to 10,000 people. So if you can just share what are our thoughts right now, let's say next year or whatever you can share right now, given whatever circumstances in terms of business that we are seeing.
This year, as you mentioned, the hiring has been slow. Even the campus hiring, we initially thought that we will actually hire a little over 500 people this year, but we have stopped at around 280. It's not that we are not hiring, but we are not really, looking at building too much of bench at this particular point of time. We have some amount of bench that we have already taken in, and because of that, our target of getting to 10,000 by March 2026, will take some amount of rethinking and realigning to see when we will be able to get there. But we are committed in making that investment. We are also making some capital investment in expanding into new premises. We are also trying to look at changing our work policy, similar to what some of the other tech companies are doing, of how much we need to work from office to how much we need to work from home. We will never go to 100% work from office, at least not in the near term. But in terms of having larger, physical presence, which will actually help us in building our talent and, retraining and reskilling, we are looking at that as well. So the hiring plans as of now, we are taking it quarter by quarter. We are not making a very long-term commitment on what kind of hiring we are going to do. But the expectation is by the first quarter of next fiscal, which is the April to June quarter of next fiscal, hopefully we should see a more clearer trend on where our customers are likely to spend and how they are likely to spend, and from which geography they are likely to spend, which will actually help us in forming up the plans for the subsequent quarters after the first quarter.
Good. And just last question on margins. I'll join back in the queue for more questions. This quarter we saw a very sharp jump in the other expenses. I think you alluded slightly in terms of your opening remark that there were some consulting expenses, etc., which were there. But can you just explain, like, other expenses that we used to report were around 55, 56 crores post the merger, but it's now jumped to 60 odd crores. So are there any one-offs here, or is it something else? If you can just explain that, and how should we think about margins in the probably coming quarters?
I'll probably give it at a high level. So we are quite confident to be there in that 16 to 18% range that we talked about in terms of EBITDA. There is no systemic challenges that I see in getting there to that particular target number. Like what you mentioned, we have had some amount of transformation expenses, some consulting expenses, which we have incurred the last couple of quarters. And there are also some rates and taxes which got adjusted as well, so which is what is showing in the other expenses in some cases. I'll have Desikan explain a little bit more detail, but our expectation is that we should be in that, we should be comfortably in the 16 to 18% range going forward.
Yeah, with respect to the other expenses, couple of things is like one is we had some training expenses which we did during the quarter that slightly increased, and one more aspect is the travel expenses. We did have quite a big travel on the Middle East side, APAC side, which has contributed to the increase. Of course, we will have some revenue impact also, but majorly this is on-site presence asked by the customer is in we did that. And last but not the least, what mentioned by Balaji is that the consultant, third-party consultant cost is also a little bit higher than what we used to have in the last quarter. So those are the major reasons for the impact.
Sure. Thank you, Desikan and Balaji. I'll come back in the queue. I have some more questions. I'll come back to.
Sure.
Thank you. We take the next question from the line of Faisal Zubair from HG Hawa and Company. Please go ahead, sir.
This target of 10,000 employees, if you study the, previous Concalls, it was at one time, calendar year 2025, then it became FY2025. And, why don't we have a clear, yes or no answer to this, whether it still remains a target or no? That's one. Second is, we are, after all, a very small company, but yes, with a very strong parent. So why are we not, attempting a bigger revenue growth and, rather than, trying to hide behind macro, tailwinds or headwinds?
I'm not able to figure out why we are not hiding behind anything at all, Mr. Hawan. So that's
no. See. Finally, this is a very small company, and the base of sales is so small that I don't think we should be, saying that there is a macro headwind that we are facing. That's why
even the group is facing the same macro challenges as well. We are all in the same business.
But
we are a small company, and if you were to look at even the other comparable companies. Even if you look at other comparable companies, they also have a similar problem. I'm not able to figure out what you're trying to indicate here.
No. You look at many other companies. They have still grown much better.
Tell me which companies are you referring to?
Let me tell you. For example, there is HCL Tech, which has a much better growth. There is Persistent Systems.
How much of it is organic and how much of it is inorganic?
Please don't interrupt me. Then there is there is also a company called one minute. Name starting.
We are tracking all the listed companies. You look at the TCS, look at Accenture, look at Wipro.
So do I. At our levels of
one thing which I don't want to accept is that you are saying that we are hiding behind something. We are not hiding behind anything.
No, because see, even the target of 10,000 employees, if you study the last con call, every time it is pushed, and by just 3-4 months.
Do you think that we will just hire and keep them here? It has to be based on the business as well, right?
So sir, if the base is so small, there has to be a strategy to fight to get a better sales growth.
This your point.
Every time the CFO refers to that one-time gain that we made in the last year and says that because of that the EBITDA has to be. We have to forget the past and look at it in a new turn a new page rather than saying that we had a one-time.
We can do that if we don't compare quarter to quarter. Of course, we can always do that. If you have to compare quarter to quarter, obviously
I would urge you to just listen to some con-call transcripts, and there are at least 8 to 9 companies which have done much higher sales and with a smaller base of sales. I have been a shareholder with you last almost 2.5-3 years. And I kind of feel this is more a strategy and a management issue rather than a headwind issue.
Sure, of course I can't change your opinion, but
no. I am on all the con calls. I study. I'm at almost, except for one AGM that I've missed in between. I feel that there is a strategy issue here rather than any headwind issue or anything. A small company like ours cannot be saying that there is a headwind.
Sure. Yeah.
Thank you. We take the next question from the line of Romil Jain from Electrum PMS. Please go ahead, sir.
Yeah, thanks for the opportunity, sir. Sir, I just want to understand more on the order booking side. So, I don't know if you can share that data, but it would be great to understand what kind of order book do we have right now, and how it has grown, maybe quarter on quarter or YOY in the last 1-2 years, and how does the pipeline, going ahead looks like, so that we can understand the prospects over the coming quarters.
Jessica, do you want to take that?
1 minute. Yeah. Can you hear me?
Yes, sir.
Yeah.
See, on the pipeline per se, of course, next quarter will be a little bit slow quarter. Combination of markets going down a little, and also you have a lot of vacation coming in, so that will have an impact on that. And one more aspect which we mentioned in our write-up is that the customer is seriously looking at how not actually getting into a big kind of an investment. They are going slow. They wanted to look at the market and do investment. That has impacted us in the pipeline side. But it is not that bad. There is a drop, but compared to this quarter, next quarter will be a little bit softer. And we expect that to increase in the calendar year, that is Jan to March, considerably. That is the one thing which we are looking at. And since Jan, most of the company in the US and the Europe will look at coming out with a new budget, which they are going through now for 24. We see that will grow. If you take into technology and engineering, we see that technology has softened, but engineering is doing decently good. We have to wait and watch for the subsequent quarter. And we don't see that it will drastically drop, but there will be a softening happen in the next 2 quarters.
So, just to get this into perspective, from where we see at this particular point of time, if our current revenue that we are projecting for the year is for the financial year is at the current 459 crores that we have done for the first half of the year, it would probably be in the range of around 910 to 920 crores compared to the 900 crores that we did last year. And out of that, 900 to 920 crores, the order book looks pretty much confirmed for, say, 850 to 860 odd crores, and the remaining 50-60 crores is something which we need to win over the next 2 quarters, per se. And if I were to look at how it was in the past, normally anywhere between 90 to 92% is the confirmed order book every quarter, and the remaining 7 to 8% is what we accrue organically during the course of the quarter as we add. And if I were to look at the starting of the year to the end of the year, normally we start the year with approximately 50 to 55% confirmed order book, and as we grow during each quarter, we add the remaining 45 odd percent. So if that gives you what Jessica mentioned and what I mentioned, is how you could probably put that into perspective.
Okay. And sir, on the slowdown, just want to understand whether the slowdown is, specific to some, let's say, some top 5 or top 10 clients that we have, something specifically to that on the technology piece of the business, or is it across the board, the clients that we have? Just trying to understand what is exactly the challenge, because last 1 or 2 quarters we have, seen the slowdown starting, and we expect another 2 quarters to be slow. So just if you can give some more granular data, it will really help us to understand what's exactly, happening.
So the challenge that we have is that we don't have any of the existing customers significantly slowing down, but they are not growing either. So that is because, most of the engagements we look at, we expect a certain amount of growth in our existing customers, and then we want to add new customers. The challenge is that the existing customers, the growth has not been in the range of what we expected normally. It's not in the double digits as what we see. And the new opportunities are smaller than what we expected. And it takes, the sales cycles are getting a little longer than what we expected. Normally, the kind of engagement that we do, we are not a very large we don't sign any large multi-million-dollar engagements. Most of the engagements are in the range of anywhere between $500,000 to $2 million to $2.5 million. And the $2 million plus deals are very getting far and few. And the growth from the existing customers are either almost at flat or slightly more than what we were doing earlier.
Okay. And sir, on the client mining side, if you can just explain, since now we are a small company right now and look to grow in the coming years. So obviously we would have strategize something on the client mining and how do we kind of keep growing. So one is organically we just tap the existing customers and go to the newer customers. But can we do something more aggressive there, or maybe if we would have already done, what kind of strategy are we looking there on the client mining side?
So we do have a key account, planning and, look at the top 10 customers and how do we actually mine those top 10 customers. And that is not just based on the numbers. It is also based on the potential of the customer as well. And for new accounts, the target that we normally have, which is what is probably the benchmark also, is approximately 90% of your annual revenue should come from your existing customers, and close to around 8 to 10% of the revenue will have to come from new customers whom you signed the last 12 months. If I look at the last 2 years, we have been ranging at around 10 to 12% from new customers and around 88% from the existing customers. But this year, we are close to around 93% of the revenues are actually coming in from 93, 94 almost coming from the existing customers, and our new customers revenue contribution has actually shrunk as well. Even though the pipeline is there, it's taking longer to get the deals to close. And we are not our business is that we are not a full-fledged system integrator. We're not the end-to-end technology service provider. We play in some specific parts within the technology implementation life cycle. So if there are now larger engagements are not happening, then that particular component of the project also is going to see delays and slowdowns. And as customers start spending more on transformation program, legacy modernization, moving to cloud and other stuff, then it will basically be that particular segment should start growing as well.
Sir, in spite our digital revenues have increased.
Mr. Jain, may we request to join the question queue?
Ma'am, this is the last question. We hardly get chance to speak with the management, even on a personal basis. So just last question from my side, please. Sir, the digital revenue has increased. Still we haven't seen that translating to the margin benefit. So how are we? Because I think on the technology side also there was a very strong engagement on the digital part of the business. So are we seeing that increasing further from here, and that will benefit the margins? Because 16 to 18% range, I remember you had always guided for that. But do we see exceeding that maybe in 2 years out from here?
Currently, the digital transformation or digital capabilities also come with a cost, because the resources whom we need to hire, the amount of training that we need to do, and some part of the teams who sit on the bench who will actually get retrained as well. So there is, while the margins are higher, the costs, at least when you're starting off or when you're in the growing phase within that particular practice, the costs are also higher. And this time, like what I had mentioned earlier, we have a slightly higher bench costs, and we also have a slightly higher training and upskilling costs as well. But once we get to a size where the digital revenues actually contribute to the maximum over a 3 to 4 quarter period, then that will stabilize and that will actually help us in improving our margins as well. But it's a constant journey because the digital technologies are not the same. So what we do this year is not the same what we do next year. So we need to keep in pace with what the market changes are.
Okay, sir. Thanks a lot and all the best, sir.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your question to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Krunal Shah from Inam Investments. Please go ahead, sir.
Yeah, hi. Thank you for the opportunity. My first question is that you mentioned that the parent business is on a cost-plus model. So can you help me understand what's the markup that we get in percentage terms?
So the markup, yeah, go ahead.
Yeah, actually we don't. This is more from a perspective of we do a internal benchmark study and we have a Big Four doing the study of what is business, what is the functional analysis and risk analysis, asset analysis we do. And post that study, we come out with a margin percentage on the cost and then decide on that. It's more very specifically, it is an arm's length pricing. Of course, I could not reveal the percentage of margin, but it is based on the study done by the Big Four, and we follow that. Because as a India, it is not only restricted to the India business. Group looks at it as at a global level. We do a global transfer pricing study and also a local transfer pricing study, which will come out with this kind of a number. So that is it.
Band that you guide for in terms of EBITDA, or would it be lower than that?
It will be around that, but yeah, it will be around that. Yeah.
Got it. Second question was on the management change. So Mr. Prashant has resigned. So could you elaborate a little bit on what has happened? Why has he resigned?
Why he has resigned, I think he will probably be able to give you that answer. Unfortunately, he's not there on the call today. So the management changes are evolving, and we also have a group level management org structure change as well.
Okay.
And with those group org structure changes, there is more ownership on how do we deliver some of the global capabilities from each one of the locations, and how the global capability leaders or people who are there in the respective countries will actually contribute more to India. With that, that's one of the reasons why some of the roles in the respective countries also have some amount of responsibility changes, and that could also be one reason. And the other one is, of course, what kind of process and opportunities that are available in the market as well.
Okay, got it. And just the last question.
But we have a strong leadership team under Prashant, and I will manage this responsibility directly.
Okay, sure. And
hello, Mr. Krunal. The line for the current questionnaire is disconnected. We take the next question from the line of Mr. Rajesh from Banyan Capital Advisors. Please go ahead, sir.
Thanks for the opportunity. So one question is, basically you were talking about earlier that there were consulting expenses and training and reskilling expenses. So is this going to be structural in the sense that it will continue for next several quarters, or was it one-off in this quarter? And if it was one-off, if you could quantify what that amount is.
I think when Balaji was mentioning about it, he was mentioning about the other expenses. It's currently in the range of 61 crores compared to 6 crores last quarter. And our training is something which has increased, and the travel has increased. On the basis of travel, that will have a flatten. It will flatten in the next quarter because we'll not have much travel coming in next quarter due to the holidays and things. On the training side, it will soften in the next quarter compared to what we did during the quarter. So I'm expecting the cost to be in the range of 58 crores to 60 crores. That's the way I look at the cost to be coming out in the next quarter.
Okay, and that is sort of the baseline that we should think about going forward, right, as opposed to what happened this quarter.
See, the one thing we always mentioned by elaborately about the digital part of the business is that we whenever we think about a training to be done, we always think about whether there is a revenue generating capability is there for our investment that we do in training. So that is something which always we look at before getting into training or before deploying the hire and train deploy people. So that aspect we ensure, then only we invest in training, otherwise we don't do it. I mean, the current state of things, even though the digital revenue is growing, it also contribute to the new technology, and we need to be updated in those technology and to get right people for that technology. And obviously technologies are dynamic, and we need to have some kind of investment we need to do for getting those business. And having said that, if you look at even in the quarter and the coming quarter, we see more of a digital business which is getting our revenue into a flat kind of a thing. So that way, now the dynamics are changing. The traditional QA kind of business is not that much growing, and digital is growing. For that, we have a certain investment which we need to make. That is a combination. But we wanted to restrict it only, and we are always very mindful about investing on training to ensure that we do get a return on that investment. That's the way we look at training as well as deploying people or including people.
So, and Rajesh, just to add to what Desikan said, that, what we look at is what are these other expenses that we are spending as a percentage of cost and as a percentage of revenue as well. In some of these quarters where, we have to make the investment for, in anticipation of some business in the future, the cost goes a little higher. But generally, we try to remain within the range of both, the other expenses in terms of cost and in terms of revenue.
Understood. And my second question, Balaji, is that the guidance you gave for this financial year revenues, does that include anything inorganic, or this is purely organic? And let's say if you do any acquisitions between now and March, that would be an additional revenue.
That's right, yeah. This is only organic. Inorganic, we don't know. We can't expect what is likely to happen.
Okay. And are there any inorganic opportunities that you think we can convert in the next 6 to 12 months?
As part of our normal business, Rajesh, similar to what we did last year, we are looking at options, but we are not sure as to whether there's anything that is going to materialize before March. We are working on a few which is in line with what our strategy is and the size that we are looking at. But, we can't say with certainty whether something is going to happen or not.
Thank you, sir. The next question is from the line of Kshitij Shah from Tusk Investments. Please go ahead.
Hi, good afternoon. I have one question on the scale-up.
There is a lot of background noise, sir. I'm not able to hear you.
Yeah, sorry. So my question was, in terms of the scale-up, when you say you're looking to go to 10,000 employees and build capabilities for a direct business later on, what are the kind of capabilities you're investing in or looking to invest in which would give you probably the long-term annuity deals which would go beyond 1 to 2 million deal values, and sort of how do you plan the journey from here to, let's say, 2, 3 to 5 years from now?
So in terms of, what kind of capabilities, we are trying to look at, we mentioned this a few years back as well in terms of strategy. What we're looking at is we are not trying to become a system integrator and build capabilities across the life cycle, because that's one is expensive and there are enough and more competition doing that work. We have been a quality assurance, quality engineering company, and what we are trying to do is to shift left and shift right within that space around business analysis, the implementation support function and DevOps and automation. And that's the area that we have been investing as well in terms of specifically on DevOps, automation, data management, cloud migration. That's the area that we have been investing in. And the last acquisition that we did was also primarily around the data governance and data quality, which will actually help us in making our entire offering around the entire assurance services or digital assurance services more complete. And in the engineering services, it's around the digital engineering, software engineering, and also about embedded engineering piece. And that's where we are looking to grow, and that's where we see opportunities to grow as well. And whatever we are trying to do, whether it is small acquisitions or what we are looking at in terms of our capability building with training and other stuff, is also primarily around these specific areas at this particular point of time. And where do we see opportunities? It's, as everybody knows, it's primarily around the digital technologies, but also what supports the digital technologies as well, which is around the data management, which is also very critical for both the AI and machine learning and generative AI and other spaces as well. We also started a new program within our company for generative AI, how it will help us in the quality assurance journey. We have an external consultant whom we have taken along with our internal teams who have been earmarked to do specific work on using generative AI for the assurance services as well. And that's where we see our opportunities growing. We don't think that we will sign a 100 million or a 200 million deal, but our objective is that if we combine these two, we can certainly go to the 5 million, 10 million opportunities internally, and we can support the group which signs the larger deals with customers, with these specific capabilities which we are going to have in India.
Thank you, sir. We take the next question from the line of Mithun Ashwath from Kiva Advisors. Please go ahead, sir. Hello? So, Mithun, your line is in the talk mode, sir. Please go ahead with your question. As there is no response from the current questioner, we'll move on to the next question from the line of Amit Tawani, an individual investor. Please go ahead with your question.
Hi, Balji. Thank you for taking my question. The first thing is that can we get some more granular details, like how much was the growth in automobiles and how much was the growth in financial services? Because I don't think there is that much granularity in the presentation.
Basically, do we have the industries covered in that?
We did have one slide showing about how much is technology versus engineering and what is the mix of both quarter-on-quarter and year-on-year same quarter. Maybe that will provide, and where engineering is majorly for auto, aero and transportation business, and technology majorly captures the BFSI. So I think that will show you the mix change during the quarters. That can give you an idea about how the engineering part of business is running and also the technology part of business is running. That may give you a view of it.
Can you give a sense of how the market is performing versus how we are performing? Because what I am noticing is that people who are in aerospace and in automobiles are doing exceptionally well. So, is there?
We can certainly share. We can certainly share the next level of detail for this particular quarter or for the first half of the year in terms of how it is. But like what I mentioned at the beginning of this call, the business that is coming in for auto and aero from the group to us, we have seen significant growth in this half of the year compared to what we have been able to sell directly in these markets. Also the other thing is that when you look at auto and aero, what you do locally for the Indian customers the margins are relatively lower. So it's better to, the way we look at it is that it's probably easier to build a capability for the work that we get from the group, rather than doing it locally here, because most of the aerospace business is either coming in from Europe or from the US. That's where the quality of the work and also the margins that you do is also higher. And that's something which we are not operating at this particular point of time, because Europe is managed through the group and that's growing. And US, we are not a predominant player at this particular point of time in that market, and we haven't really done that investment to grow in that particular market so far. But we can certainly share with you what our, what the group versus a direct trend, for the first half of the year.
Thank you, sir. The next question is from the line of Mithun Ashwath from Kiva Advisors. Please go ahead.
Hi. My question is more a little bit in terms of what is your strategic thinking at the global level. I think Rajesh was on some calls before, but just the thinking of the group of why merging all these businesses into this company, the Pune-based business, which is unlisted, because, we were delivering maybe, stronger margins and growth when we were standalone. And the expectation was with the merger, you could, grow even faster. So I just wanted to understand, because I think, when Rajesh was on the call, he was talking about India being a very important destination for outsourcing, and obviously you piggybacking on that growth. So I just wanted to understand from the group level, what is the thinking of the Indian entity, because there were some reports that there could be an exit of this India business as well in the newspapers. So I just want you to put to rest if that is not true, and, where this is going in terms of the next 3 to 4 years. And maybe if even Rajesh can be on the call next time, it will, help, minority investors to get an understanding of what is the strategic direction of this listed company.
Sure. I'll try and answer this. I obviously can't talk about the speculation on the group exiting India business and other stuff, because that's something which I'm not aware of, and neither not even the wildest of dreams we came across those kind of thoughts. Of course, there were some media reports about somebody buying us, but that is not only for India, is what my understanding is. But nevertheless, the group strategy is that they have 3 shore centers, India, Morocco, and Romania, or India, Romania, Morocco, in that order. And whatever group's business that they want to pay shore, because that's what the customer's demands are, and that's where both the cost and the scalability advantages. India is not being looked at only from a cost perspective, but also scalability. And the expectation is for the group's business to grow in India. And I had mentioned, when we were talking about the merger as well, that when the merger happened, the group business that we were doing was approximately 25%, 25 to 26%, and the direct business was around 74%. And by 2025, the end of financial year 2025, which is March 2026, we are expecting that the group business will be 45% and the direct business will be 55%. Which doesn't mean that the direct business will not grow, but the group business is supposed to outgrow the direct business by that much. The group business, even though might not be at a much higher margin, but it is a far more safer and a lesser cost work for us, because we don't really have to invest in the sales element, and that's what the plan is as well, and that particular strategy still stands. And we at this particular point of time, as of first half of this year, the group business is approximately 33%, so it's grown from around 25-26% to 33% of the total business. And the direct business, unfortunately for this 2023, has not really seen a significant growth per se. But we are still growing in a marginal 2-3% per quarter range in the direct business, which will translate to a little over 10% in the direct business growth. But the group business is growing faster in terms of headcount, and that's what the plan is. I'll certainly request Rajesh to be there in the call, for February 2024. Hopefully, he should be here during that time, but I'll certainly request for him to be there to answer any questions and concerns.
My next question was just on, obviously maybe because the group business is becoming a larger portion, is it difficult for you to kind of model what kind of growth your company is going to deliver? Because on a quarter-to-quarter basis, there is a bit of variation, and actually this quarter you saw some quarter-on-quarter growth in revenues, despite you guiding for maybe kind of a subdued quarter. So I just wanted to get a sense on that. And are we at the worst in terms of the margin picture? And when things pick up from the global side, from your parent, do you see overall revenue starting to pick up? And also wanted to know whether the parent has any exposure to the U.S. and they still haven't made that step. So just wanted your thoughts on that.
Sure. The group business is more predictable, but once again, just wanted to add, whatever group business that we are getting is not an existing business that is being delivered, which is moving to India. It's only whatever new businesses that are being won are moving partially to India, because that's something which we are including as part of the solution and as part of selling to the customer. The existing business moving into India is a little slower, because I mentioned even earlier as well, because the markets in which we operate from the group are more protected markets. You can't just reduce the number of headcount and that market can move to India, because there is a lot more impact in many of those elements as well. And as and when the group, this year, the group also is going to grow by close to around 10 to 11%, even though the market is a little subdued. And that's what we are seeing in our group headcount growth as well, for this year. Hopefully, this should help us in the coming quarters. Once this particular trend, because this is something which has been happening for the last 3-4 quarters, once we are able to see the trend and how we are able to tap the pipeline that the group is winning into actual work for us here in India, we should be able to make that at least the group revenue side more predictable for the full year rather than quarter on quarter. And for the direct markets, we anyway have our own budgets which we define and make sure that we go to meet those particular budgets. This year, like what I mentioned, we are not able to meet some of those targets which we set for ourselves. But hopefully 2024 should be different. Hello? Hello?
Hello? Asha? Sorry,
Seema, Asha, are you guys there?
So the line for the questioner has dropped.
Okay.
We can take the next question. Our next question.
Yeah, we can take this we can keep this as the last question now.
Okay. Our last question is from the line of Amit Tawani, an individual investor. Please go ahead.
So thank you for allowing me a follow-up question. I wanted to, because it is, the margins seem to have dropped in the last 2 quarters. Is it related to some, wage hike that we have taken this year that is not been able to, that we've not been able to pass on? Or is it related to some rate reduction that has happened from the client front? Can you give us some colors there?
Sure. So, the first point is right, because last year, as we all know, 2022 to 2023, there was a significant amount of wage increases that we had to go through during 2022, which is impacting us in 2023 as well. And obviously, there is a lag between when we do the wage increase to when we'll be able to translate that to the customers. But that's only one part of it. The other part is, this year, considering what we were not expecting that the year is going to be slow, so we made some investment on talent, people, bench, stuff, which also is contributing to some part of the cost. And the other one, basically, do you want to add? I'm not sure about that, the rates and taxes piece. Do you want to add anything more beyond the people cost piece?
No, on the people cost, of course, we did have, compared to the last year, the current year, we have increase in the headcount. And also, it also contribute with the increase in headcount and also, sorry?
Not just increase in headcount, but the cost per headcount as well, particularly in the digital.
Exactly. No, I was about to again the increase in headcount. Correct. So the first one is the headcount increase quantity-wise, and also from the increment perspective, it will also both contribute to the overall increase in the cost. And that is one part. And as I mentioned, compared to the previous quarters, we had travel increasing for the APAC and Middle East region. And of course, the last but not the least is the training aspect of it, which we are doing it for the purpose of generating more revenue and generating our capability. So those are the major aspects of things which, and also the consulting fees, because where in case if you don't have a in-house, you need to go for a third party. But if I look at compared to last year where we had one client having a lot of consultants, that has reduced. Having said that, we do have some increase on a quarter-on-quarter basis on the third-party consultant cost for ensuring that we get the revenue which is on the table and not waiting for us to improve our capability in-house and deliver it. So those are the couple of things which I can say that is the contributors for a cost increase compared to the last year. Hello? Hello? Akshay?
Amit, are you there?
Hello.
Yes, I'm very much there. Hello.
Oh, okay. Yeah, hello, please.
Yeah, can you hear me?
Yes, we can.
Yeah. Yes, now we can.
Since that we have realized that the demand is not as per our expectations, do we expect to go a little slow on hiring in the future, or are we still looking to hire?
Yeah, we are taking that quarter on quarter now because I mentioned this earlier in one of the other questions as well. Earlier, we were planning to do almost 500 people to be hired from the campuses. We reduced it to 270, because we are not seeing the same level of demand. And even the other hires, we are actually taking a look quarter on quarter rather than hiring well in advance. But that obviously that will also impact our ability to grow in the future. So we are trying to balance between the two.
Thank you, Balaji. Thank you so much for your replies.
Thank you so much, Seema. We can probably close the call. Thank you so much for all the investors and participants who joined us today. I wish you all a very happy, safe, and colorful Diwali. And hope to see you all in the next call again. Thank you.
Yeah, happy Diwali to you and your family. Thank you very much.
Thank you very much. On behalf of Expleo Solutions Limited, that concludes today's conference call. Thank you for joining us, and you may now disconnect your lines.